Hi, welcome to Volatility 411 for Tuesday, October 13th. I'm Russell Rhodes, Head of Research and Consulting at EQ Derivatives. S&P 500 taking a little bit of a breather, down 1/3%. VIX is up 88 cents to 25.95. Near part of the curve, October, November, December, 26.70, 28.70, and 27.85. So the October contract has narrowed that spread with spot VIX. It's down to 75 cents. Looking at the January 2021 through the June 2021 contracts, they're priced at 27.75 to 26.70, $1 and a nickel range over those 6 months, and it just trends down as we get out to June. Last week, I talked about the specific expirations that go into the VIX calculation, the SPX expirations. Right now, it's November 6th and November 13th. November 6th is the first Friday after the U.S. presidential election, but those expirations are going to start to move out a little bit. And I just took a look at the money implied volatility for the 4 Fridays where we've got SPX expiration in November. November 6th is at 22.64. November 13th is 22.30. November 20th is 22.14. And then you go out to November 27th, which is 21.95. The reason I point this out, and of course, these are at the money implied volatilities, but it does show that the VIX index will experience a little bit of headwind as the calculation that feeds into VIX starts feeding from SPX options that expire farther out from the election. And finally, yesterday I was talking on Twitter about somebody that sold 17,800 of the October 30 calls and took in 62 cents. And at the same time, they bought 17,800 of the 37.5 calls for 18 cents. That was a 44-cent credit. Looks like it's not a bear call spread. Actually, looks like they were rolling down from the October 37.5s to the October 30s and taking in a 44-cent credit because the 37.5s appear to have been closed out. And then today, somebody's still looking at those October 30 calls. Somebody sold 1,500 of them very early in the day, taking in 60 cents. So with all of that, I'm Russell Rhodes, and that's your Volatility 411.